Hello, everybody. Welcome to our program. I'm your host, Ivy Han. If there's been a major theme for investors in the summer of 2022, it's likely their concerns about the state of the global economy. Many developed countries around the world have experienced high inflation, rising interest rates, and rocky performance in the financial markets. These topics have grabbed the attention of Canadian investors and have them wondering what comes next for the economy. Their web searches behavior tells the story. Here's a look at the popularity of web searches in Canada for inflation in red and recession in blue. These two topics saw a surge of interest in the summer of 2022, peaking in June and July. And they remain top of mind heading into the fall. Many investors are now looking for ways to hedge their portfolio against economic shocks in the developed world. And that has them consider the possibilities of having emerging market investments. So let's find out how these investments work and what they might bring to an investor's portfolio. So joining us today is Matthew Strauss. He is Senior Vice President and Portfolio Manager for Global Equities at CI Global Asset Management. Matthew will take turns to explain the key features of emerging market economies, some of the risks and opportunities to understand, and as well as some factors to consider when researching them. So Matthew, thanks so much for joining me. It's a pleasure having you today.
No, thank you, Ivy. Joining an interesting time. I mean, if you just look
Absolutely.
what's happening worldwide, interesting time also to talk about emerging markets.
For sure. Can you maybe share a little bit about what you do in your role at CI?
Yeah, I'm wearing a few hats, but I'm also running the Emerging Market Fund, which I've been running for more than 10 years here at CI. And then I also oversee the global equity funds. And there's another fund, global equity fund, that I specifically are responsible for. And then also part of the asset allocation committee, where we look more at our asset allocator funds. So that's kind of the hats that I'm wearing. But my passion continues to be, and that's my background as well, continues to be emerging markets.
Mm-hmm. And speaking of that, why did you decide to focus on emerging markets as a portfolio manager?
Look, maybe because I grew up in a country that was even below emerging markets, Namibia, just north of South Africa. So a lot of my experience was out of an emerging market, or then a frontier market, to be technically correct. But the one thing that I really like as a career, emerging markets and following investments in emerging markets, is the dynamic in emerging markets. It's never just about the company or just about the country. There are so many influences, whether it's political, whether it's a company, whether it is geopolitical tension that can influence a company's performance. For me, that makes it a very interesting environment to invest in. But also, and I think that's where the interesting part is, because there's so many moving parts, it creates opportunities where you can have what we would call an information advantage than compared to a company where you just look at the company, their financials, you might meet the management or not, and then you have to make a decision.
Mm-hmm. And Matthew, those are very interesting points. And now, before we dive into our actual conversation, I have a trivia question for our audience. So the trivia question is, what percentage of global GDP did the top 20 emerging market countries account for in US dollar terms at the end of 2020? And we'll review the answer at the end of our conversation. So stay tuned. All right, Matthew. So here comes my, I would say, first question. So let's maybe, talk to our audience about what are some of the defining characteristics that make a country or geographic region an emerging market?
Look, it's a bit of a moving target, because you have to look at the economy and the development stage of the economy, as well as accessibility to in the markets, the equity market, the fixed income market. So if we look at the economy, normally it's classified as middle income economies. So the way the World Bank would classify that would be economies that have an per capita GDP, or gross national product that they have, from around $1,000 to up to around $12,000, $13,000. It's economies that are truly emerging. They're not developed market economies yet, but they have moved away from really low developed economies to this middle group. But then the other part is it must be investable, because we do see some economies where they have moved into this middle group of economic development, so the so-called middle income economies, but then their markets are not accessible. So they cannot join this group of investable emerging market economies. There's actually some two exceptions here that are on the other side. If we look at their economic development, Taiwan and South Korea, one would think they should be developed markets. But because of technical reasons on their investability, they continue to remain part of the emerging market group. So it's actually a vast group of, call it between 25 and 30 countries, that goes from countries as lowly developed or as poor and early stage development as Egypt or even the Philippines, to as highly developed as Taiwan and South Korea. The big ones, obviously, within this group would be India, China, South Africa, Brazil. Those would be the big economies within this group.
And what are some risks that investors should understand when investing in emerging markets?
Look, there's a number of risks. The one I think that would come, if you say emerging markets, that immediately comes to mind would be political risk. Now, it's a bit of an unfair taint these days, because if we think emerging markets, late 1980s and throughout the 1990s, there had been a lot of violent changeovers of governments. If we think Latin America, where there had been coups. So that was the perception of politics in the emerging market world. A lot of the politics have stabilized. Not all of them are democracies, but they stay stable political systems. But it is still a risk. I mean, we do see some surprise changes from time to time. But if we think what's happening currently in the developed markets, if we think about Europe, if we think about the US over the last 6, 7, 8 years, the political turmoil within the US, I think that gap between what developed market political risk would be and what emerging market political risk would be had narrowed quite significantly. But then some of the other risks are still very real, and we have to take that into account. And that's why we travel a lot to emerging markets, either myself or the team, and why we try to meet regulators and policymakers is actually on the regulatory side, because the regulatory side is still developing. We're getting some surprises, sometimes positive, but also sometimes negative surprises from the regulator that suddenly change. The best example would be last year, which was a number of negative regulatory developments that came out of China that affected, for instance, the education sector, the e-commerce sector. So you have to be fairly close to the not just the regulators, but the politicians, the government itself, to understand what they're thinking and where potential regulatory changes might come and what that might look like. So that is still a very big risk that one should take into account. Then if we go to maybe a third risk, would be the companies themselves and the balance sheets and the trustworthiness of the companies, or to use the governance issue on when it comes to companies. Some of them are actually highly developed and their disclosures are really good, but some of the other companies, it's not the case. It means that analyzing the financial statements of emerging market companies should just be the starting point. It's just the beginning, and often you would come back to verify what had been said in the statements, whether it's true, whether it's confirmed by management, whether it's confirmed by the competition, what they're saying. So it is, I would say, yes, there's political risk, there's regulatory risk, and then you have to go well beyond the financial statements to understand the company's true nature, because there is always that risk on the governance side that you have to take into account. Two other risks that I can think about would be liquidity, because there are some really big companies. If we think about a Tencent or Alibaba, which you don't have to consider liquidity because it is as liquid as some of the most liquid companies globally. But in a lot of the interesting opportunities, you have to consider liquidity. And it's not so much buying into the company. You also have to think if the company is doing as well as one is hoping, that you can get out. Or if there's a problem, can you get quickly out of that position? So liquidity is something that you have to consider for a number of companies in the emerging market world. Then I would say the other big risk, and that's why we also have within our portfolio, although it's an equity portfolio, we like the currency hedging part of that, active currency hedging, because currencies can often come back to haunt you if you're fully exposed to the currency moves, because we do get emerging market currencies moving quite significantly over periods and often in a negative way. So there's two ways to manage that: is to hedge it, or you can say, but yes, even if the currency weaken, the return I will get from my equities and the underlying investment would far offset that weakness. But that is something that you have to consider, because it could become, if not the most important, one of the important drivers of your returns if you measure it in US dollars or in Canadian dollars.
Right. So those are some interesting points, Matthew. So let's chat through some of the key opportunities from gaining exposure to emerging markets, especially as many developed countries or economies currently deal with market downturns. And the first is economic diversification. So, what are the potential benefits with this?
I think there's a few things, because emerging markets themselves are so diversified. Uh, what you do get is not a full delinking from the world, but you get sometimes a bit of a different cycle, or a little bit earlier in the cycle, or a little bit later in the cycle. A good example would be the current situation, where we're seeing in the developed markets, and especially then driven by the US, central banks tightening, hiking rates. And therefore, there's also this concern: what will that impact ultimately be on the economy? Will the economy head for the recession? But all the talk is about the slowdown in those economies. Compare that to China, where they're actually on the other side of the economic cycle, where they are cutting rates, they are stimulating the economy. They are talking about what the recovery would look like. So right there is diversification that you're getting, and that's giving you a different cycle than what you would find in North America or in the developed markets. Another part of diversification is just on the growth side. You're getting some really, really strong growth. Emerging markets now drives global growth. I mean, yes, if we look at the total size of emerging markets, it's not yet fully 50% of the world's GDP or the world's economy. But if we look at where the majority of growth comes from, it comes out of emerging markets. And that's an important diversification that you're getting. You're really getting exposure then to high growth economies, and economies that are growing generally higher than what you've seen in developed markets. So those are some of the advantages that you can get by diversifying into emerging markets.
On a similar note, in many developed markets now, a lot of these markets are now dealing with high inflation, labor shortages, rising interest rates, which can pose a lot of challenges. Now, what does the scene look like now in emerging markets, broadly speaking?
Look, I wish I could say it's totally different in emerging markets. But what we've seen, because this whole inflation wave started with higher energy prices, it affects all markets. It spilled over into higher food prices. It affects all markets. So they have really struggled with inflation like the rest of the world. Now, the good part is inflation is something they are very familiar with, especially if we look at like Latin America. So it's unlike the developed markets, which after a 10-year period where they really now think, oh, wow, we have high inflation. Inflation is a very common phenomena in the emerging markets. And in the 1990s, it was really a big problem. So as a result, we have seen emerging market central banks, and I would specifically focus here on Latin America, reacting to the threat of inflation much earlier than other central banks. Like Brazil, they have actually hiked rates. Their first rate hike was in March 2021. So exactly 12 months before the Fed's first rate hike. So what we've seen now is, because they have been so much more proactive in fighting inflation, the negative spillover into the economy, the fear of higher interest rates and how high interest rates can go, is coming towards an end in Latin America. And we are already looking into 2023 at the peak, but not only the peak, when the first rate cuts would come. Now, we're seeing that not only in Latin America, in some of the other economies. There are a few in Asia where they are more in line with the developed market hiking cycle. But that's where I'm more comfortable that on the one hand, you have certain areas where we're getting closer to the end of the cycle, which makes it more interesting to invest in. But also from a growth perspective, a lot of these economies are coming from a significant, and here we're talking more Asia again, from higher growth rates. So the negative impact of high inflation, high interest rates on growth will bring their growth rates down, but not push them into recession. It's just slower growth.
Now, the second opportunity to consider with the emerging markets is their potential for higher return. What sort of outperformance have we historically seen in emerging markets compared to developed ones?
So I think there's a few ways to look at it. One could look at absolute outperformance, which actually looks quite spectacular, especially to markets outside the US. And then if we look at the last 20 years, if we take it from the turn of the century up to this year, emerging markets have clearly outperformed the developed markets outside the US. So the Europes, the Japans, Australia taken together. But not only have they outperformed them, what is interesting, if we look at volatility, yes, emerging market volatility significantly higher. But if we look at a measure called the Sharpe ratio, where we take volatility and return. So now you're saying, okay, I'm getting more return, but what kind of volatility I'm taking, the standard deviation. If you take that volatility and you combine them, emerging markets have actually outperformed developed markets outside the US. So there is an even on a risk-adjusted basis, emerging markets look quite compelling. As a diversification element, it's actually a very good diversifier. And if you're considering outside the US, even historically, emerging markets would have been a better bet. The other part that we've seen, this is taking over the last 20 years, the volatility and the returns. Volatility in emerging markets have come down much more than in developed markets. So that gap have closed very, very significantly. It hasn't closed, but it have narrowed significantly. But even with that higher volatility in the 2000s, emerging markets still outperformed on a risk-adjusted basis.
That's certainly interesting. Now, you mentioned, and I love the fact that you mentioned about trading volatility. So let's talk a little bit more about that because we know emerging markets are generally less politically and economically stable, as you mentioned, than developed markets. So, what sort of trading volatility should investors expect with emerging market investments?
If one is going to try and just play emerging markets, I'm going to go in and a week later or a month later or even a quarter later, I'm going to sell. Look, you might make some money and that would be good. However, that's an almost just a trading and close to a betting game on emerging markets because there's so many factors, as we've discussed earlier on, so many factors that play into emerging markets that anything could change over a short period. To see a 10% loss in emerging market as the index is not an strange phenomena. Now, one would probably say of developed markets the same thing during the last 6 months, but with emerging markets, it can happen more often that you would see those losses, but then also in subsequent quarters, recovery or even in some cases over a shorter time period, a recovery of those losses. But then if you start going down into the mid cap, so the smaller emerging market company, then they start behaving more like small cap in the developed markets, where you kind of get these volatilities where a swing of a 10, 20% in the stock over a number of weeks would not be a major surprise. But with those stocks, normally you want to be compensated that your return that you're expecting on those stocks should be quite significant. And that's where it comes back to, if you look at emerging markets, it is, or what we would prefer is a portfolio approach rather than picking one or two stocks, which could work either spectacularly well or it could go spectacularly the other way, is more to have a portfolio so that one can mitigate some of the stocks that are higher volatility with lower volatility stocks across the EM or the emerging market portfolio. So it is more looking at the longer term. So here we're starting to look a multi-year kind of investment into emerging markets. Because if you look at that, then you can also start looking a bit through the shorter term volatility. And then you're investing in the structural growth that we're seeing out of emerging markets. You're investing in companies that are structurally growing to become even global competitors.
Hmm. And thank you for pointing it out. Especially, I would say for investors who are maybe getting into it for the first time, it's important to know, what are the risks involved and things to consider. Now, that brings me to talk about valuation. So, the third opportunity to consider with emerging markets is the potential to exploit inefficiencies in company valuations. Now, I think you mentioned that earlier. So, what do you mean by that? Can you elaborate a little bit more on that in terms of company valuation?
Yes, and that's again where we talk of being compensated for risk. Generally, a like for like company in the emerging market trade at a discount because there's additional risk. But in that, then it also means there's this potential of higher returns than their developed market peers. And even if we look at it on a total index basis, it tends to trade at a discount. The discount normally to the developed market peers would be in the region of, call it around 20%. And then when you go through periods where emerging markets really struggle compared to their developed market peers, that discount can be up to a 30 or 35%. But a discount is really there to compensate for this additional risk. Because if you're going to pay for a developed market, for an emerging market company, exactly the same valuation than a developed market company, then your underlying assumption would be everything else is the same. And we know it's not. Currently, I would say on a cyclical basis, if we look at emerging markets in general, it is trading at a 30-35% discount to developed markets. So as a cyclical entry point, it is actually quite a compelling time for us on the emerging markets if we just consider valuation. Now, valuation is I always say, it's never the begin all and end all why you should buy a stock or a region or emerging market assets, but it is just another good reason to consider when buying these assets.
Hmm. I guess nobody doesn't like the fact that you can buy stuff on a discount, right? So probably the same for when it comes to stock trading
Stocks are
on a
no
discount,
different.
right? Exactly. You're going. It's like walking to a Costco and buying stuff on sale, right? Now, when it comes to gaining exposure to emerging markets, you mentioned a couple times about diversification, right? Having a diversified approach, and especially maybe using products such as mutual funds or exchange traded funds, for example, may be worth considering. Now, can you elaborate a little bit more on that?
Yes, I think if we look at mutual funds or even then the exchange traded funds, the the beauty of going through that instrument or those instruments rather than the individual stocks we touched on earlier is the volatility side. Now, one could then say, do you go for an passive ETF, which will replicate uh, the index? And mostly this is an index compiled by MSCI. It's the gold standard index, but it's a passive index or an active index. Now, the one thing people will be quick to point out, yeah, generally passives are really inexpensive. But one must remember within emerging markets, if we look because it is more exotic markets compared to the developed markets, what we've seen, generally speaking, the fees on even the passive ETFs are not cheap. I
Hmm.
mean, it's cheaper than active, but it's not cheap. It's not comparable with having a passive S&P 500 ETF, for instance. But then the other part, and in here we're getting to active ETFs and active managed funds, where with emerging markets it does make a difference. Given the diversity within emerging markets, we talked earlier about 25 to 30 countries, and these countries have different governments, they have different regulatory systems, they have different central banks, different currencies. Then you overlay that with the companies operating in these environments. The information advantage that you can get out of emerging market investments, if you're willing to put in the effort, if you're willing to visit the companies, to have the meetings, to read up, to make sure that you speak to government officials that are important for that industry, that advantage that you can gain by gathering these informations on the ground should actually give you a better opportunity than just following the index. For instance, selling out of Russia or not having Russian exposure before it got kicked out of the index, or starting to reduce that when when the Russian-Ukrainian situation started building, would be an advantage over and above a passive index, because the passive index will remain there until it's kicked out. Or being in countries like Turkey, which the index just have to be there. And as an active manager, you can take a view, okay, do I like the situation and also how the country is managed and where it's heading, or do we decide not to be in that country? So one can do that. One can do that, and obviously on a stock specific side as well. So there's just a lot of other things. The other side of active, and we've also touched on that, is the currency. If we as active managers do get worried about the currency, we have within our portfolios, we have the ability then to hedge that. So we don't want to sell the underlying because we believe in the company. We're just worried about the short-term moves in the currency. Then we can hedge that away. The passive cannot do that. Yeah, and maybe the last one, which we're now in a period where IPOs, initial public offerings, are not very significant. But what we've seen in the past, initial public offerings are actually a big source of returns. Because if you know the company, you can get a decent allocation, and you're kind of a bit ahead of the rest of the market. You're definitely ahead of passive ETFs, because they can only invest in that company once it becomes part of the index. But we then as active can invest before it becomes part of the index. So these are the different ways one can invest to diversify and to get certain expertise as part of the package, whether it's in a fund or an ETF, and then whether it's an active or a passive ETF.
All right, Matthew. You've shared a lot about the potential benefits of a diversified approach to investing in emerging markets. So I wanted to take a quick moment to show our audience how they can start their research into emerging market funds using the Fund Screener tool within WebBroker. Once in WebBroker, click on Research. And under the Tools tab, click on Screeners. The Screeners tool allows you to filter for investments by specific criteria. You're able to filter for stocks, technical events, mutual fund, and in this case, ETFs. Under the ETFs tab, you're able to create a new screen by clicking on Create Custom Screen. This will bring you to a page with a variety of criteria that you're able to use to filter out ETFs. Today, we will use the fund category criteria to look up emerging market funds as an example. Click to add this particular criteria. Scrolling down, and once you're here, you're able to choose the specific category you're seeking for this particular ETF. In this case, we're looking for Canada Emerging Markets Equity as a category in itself. And once you locate the ETF category that you would like, click on the category, and you'll see how many ETFs fit in that category on the right. We have 54 ETFs that fall under the Canada Emerging Markets Equity category. You can add additional criteria to your screen as well. So for example, towards the top left, you're able to go under any of those tabs. And if we go under holding allocation, for example, you're actually able to add top sector holding, top regional holding, top 10 holdings include specific securities, and essentially you're trying to make your screening results more selective. To show you the matches for your ETF, and keep in mind that this will include mutual funds in your search results. If you only want ETFs, simply uncheck the box and to view the matches again. In this instance, we're going to keep this unchecked and click on View 30 Matches. And it's going to take you to this page where you're going to be able to see different types of information available for your screen results. So information like fund category, last trade price, profile information, fund inception, when it started, rating information such as the Morningstar risk adjusted rating, performance information from 1 month up to 10 years, additional risk metrics, and holding information. And on this page, you're also able to pick up to 5 funds to compare side by side. And for example, we're just going to pick the first 5 for demonstration. And once you have up to 5 selected, simply click on compare, and this will bring you to a page that shows you all of the funds selected, and you're able to view these funds side by side and compare some information. And again, you can view performance information, you can look at ratings information, so similar information to what you saw on the last page, except the funds are now going to be side by side for comparison. And finally, if you'd like to see more information on each of the ETF in your screen, simply click on that ETF. A box will pop up and you would want to click on the summary. And this will bring you to a page that gives you some additional information about this ETF. And on this page, you'll find additional detailed information on how to trade this ETF, sector and geographic region breakdown, top 10 holdings within this ETF, Morningstar ratings on a risk adjusted basis over on the top right. And then towards the bottom, you're going to see some additional fundamental information. So hopefully that demo helps our audience to conduct research and to make it just a little bit clear in terms of how they can start their research process. Now, we're going to move on to our live Q&A in just a moment. But before we do that, just wanted to bring up the answer to our trivia question. So Matthew, I think you might know the answer to this one, but we'll hold it off for our audience. So as a refresher, the question was, what percentage of global GDP did the top 20 emerging market countries account for in US dollar terms at the end of 2020? So the trivia answer is the top 20 emerging market countries account for 34% of the global nominal GDP in US dollar terms at the end of 2020, according to the data sourced by the International Monetary Fund. However, that figure rises to 46% of the global GDP when purchasing power parity is considered. So with that, Matthew, I just wanted to thank you again for just a very interesting discussion, but I'm sure our audience wanted to hear a little bit more from you. So let's dive into our live Q&A.